The Central Bank of Kenya says the decision to retain the benchmark lending rate at 7% was based on the overall inflation driven by increased cost of basic food commodities, fuel, and implementation of new tax measures. The central bank rate has been at 7% over the last 18 months. In a post-monetary policy committee briefing, Central Bank Governor Dr. Patrick Njoroge, however, said even though inflation pressures are expected to be elevated in the near term, it will remain within the government's target of between 2.5 to 7.5% with muted damage pressures. He said implementation of the reforms outlined in the MPC white paper, focusing on refining macroeconomic modeling and forecasting frameworks in line with changing structure of the economic, among others, would enhance the effectiveness of monetary policy and support anchoring of inflation expectations.
At 6.3, which is inside the range. Our target range is 5% plus or minus 2.5 percentage points. So it's inside the range. There is some of the sort of external pressures. There's also other pressures, domestic pressures. If you look at this from a perspective of month on month, so here is where the 12 months is a bit, may not always, let's say, resonate with consumers. Maybe the month on month. So you go to the market today and you are there, let's say, a month ago, and you see the sticker shock, the change in price between 1 month and the next. And there you have things like Sukuma Wiki. Those have really moved in the last sort of over 1 month. Sukuma Wiki has been big there as well, beef with bones, etc.